Hi, everyone. Thank you for joining us for today's webinar, Anticipating Changes for Employer-Sponsored Plans in 2025 and What You Might Expect with the New Administration. I am Tracy Best. I'm with C3, and we're excited to work with our clients on helping them navigate what's going on currently and what they can expect going forward. We are really excited to partner with Warner Pacific, who brought us our incredible presenter here today, Janet Troutwine. Just a few housekeeping items. We are going to be recording the webinar today, so if you can put your questions in the Q&A feature, what we will do is answer as many questions as we can at the end of the presentation. And if we do not get to your question by the time we wrap up, then we will make sure that everyone on the call today gets the Q&A responses. So with that, I am excited to introduce our speaker today, who's Janet Troutwine. She is the Vice President of the Large Group Segment and Compliance at Warner Pacific, and she has over 35 years of employee benefits and health industry experience. One of the things that makes Janet very special is her background, as she was the CEO of National Association of Benefits and Insurance Professionals for over 26 years, where she worked with members of Congress, senior government officials, and state legislators. She is a national speaker on health policy and health reform. She also has a bachelor's degree from George Mason University in Government and International Affairs and a master in health economics, policy, and management from the London School of Economics. So with that, very well versed and very connected on what's happening, and we're excited for Janet to join us today.
Well, thank you, Tracy, and I'm very happy to be able to talk to everyone that's on today and listening. And so I will tell you regarding the questions you come up with, you can ask anything about what I talked about or what I didn't talk about. And I'll try to answer them as best as we can as Tracy said, at the end. So I guess I want to start off saying that right now, this word anticipating is pretty important because in any new administration, they have a lot of things that they try to get done initially, and they don't always show all of their cards as to what they might have in mind. And then we have to take into consideration the things that Congress believes are priorities because they definitely have a role in what happens. And we have to look at, what happened in the past administration that might be undone. So there's a lot of this will be me telling you a few things that they have done, but also some things that they might do and why they might do them. I guess I would start off saying one thing, and then we'll definitely dive right in here. I think people who live in the real world, like you and I do, we sometimes expect the behavior of our elected officials and people that are appointed to the agencies, to be logical, and they would make decisions in life and about the things that affect all of us for very logical reasons and be able to track all of that. But I will tell you, having been in Washington for such a long time, that is absolutely not the way any of them make decisions on either side of the aisle. They do consider policy issues that they think are important to them, but every single decision that they make is interwoven into the politics of the situation. In other words, if I do this, will it help me get reelected or will it keep me from being elected? If I do this, will it make my polling numbers go up or down? How many people will it actually affect? And so forth. And so it's every decision is completely interwoven and inseparable. And I would love to tell you that they always do things for the right reason, what we would think is the right reason, but that's not the way it is. And it's not to say anything bad about members of Congress or other elected officials. Most of them are just regular people who want to do the right thing, but they also know that if they don't stay in Congress, for example, long enough to get done what they initially planned to go in and do, then they won't have an opportunity to do whatever those important policy issues are. So they have to make sure that they'll be reelected so they have an opportunity to do that. So I'm going to jump right in here, and I'm going to start off talking about a little bit about some things that happened at the end of last year. And you may be aware of some of these things, so I'm going to go through them fairly quickly. But we did have some changes in the reporting process. I will say that we've been working with employer groups on this particular issue for over 10 years. That's how long it takes sometimes to get something important done. And what it does is create just some additional opportunities for, I don't know if I should call it leniency or a little bit of leeway in the way things are reported. I know that we're past reporting times for this year, but I just want to make sure that everyone is aware of the things that they can pick up next year if they didn't do it this year. So for one, you no longer have to automatically provide individual statements to participants unless they are requested of you. If you as an employer get a letter from the IRS, you used to have to respond in 30 days, and some of the things they would ask for would not be possible to produce in 30 days. So now they're allowing 90 days. And then there's an extended or a more limited period of time for them to actually collect their assessments. So they can't wait as long as they have in some situations to do their initial reviews. Also, one of the things that really we think is most important is that that something that many of you have probably already struggled with, particularly if you have a lot of turnover in your business, and that is tracking down something that comes back with a social security number that is rejected, and you're trying to track down the employee, and the employee is long gone, and you're unable to go back and retrospectively collect that information. So if that is the case, employers are able to use the full name and birth date of that person, as well as insurers if they're the ones that's doing the reporting for them. Those are pretty important, particularly also, those are, as you may be aware, it's difficult to collect that information, not just for the employee, but on those dependents. Getting that information with all of their complete dependent information is kind of difficult sometimes, particularly those social security numbers. So this really will make it a lot easier, and hopefully that will be helpful to all of you. And then I know that you've been working with C3 on your RxDC reporting. And I will just say that when you get those notices from carriers, please do your best to fill those out on a timely basis. If your group is fully insured, then the carrier is going to file a report on your behalf, but there is a small amount of information that they do not normally have, and that's what they're asking for in these surveys. So what will happen is, let's say you missed the survey altogether, they will go ahead and file because the carriers are required to file for you. But when it comes there, if there may not be able to actually attribute your specific information to you, and they might report it as in aggregate, which is not as helpful in doing what they're trying to do with RxDC reporting, which is actually bring down the cost of prescription drugs and plans, which will bring down overall cost of the plans. So it's always best to fill out the carrier survey, but no one should panic if they missed it, because there's another opportunity to do that later if you're requested to provide additional information. Of course, employers that have self-funded plans have to do the whole thing themselves. It's always with the help of their third-party administrator or their carrier or their pharmacy benefit manager, or all three. Another thing, just to remind you, and I'm sure that you all saw this, I do find there's a lot of misinformation out there about this, though, and it has to do with the telehealth exception that we got relative to HSA plans. And this occurred during the pandemic period, and it expired at the end of last year. And a lot of people have been confused about this because they think that they can still have telehealth for people who elect an HSA, because they heard that there'd been an extension. But that extension was only for Medicare beneficiaries. It was not for private plans. This has a lot of bipartisan support. And frankly, I'm surprised that Congress has not already acted on this and done another extension for private plans, but they haven't yet, which means that for someone who has an HSA and they also have telemedicine benefit, theoretically, they are not supposed to contribute to their HSA because the telemedicine represents a benefit that is payable before the deductible is met, which is prohibited in an HSA plan to have something that's payable before the deductible. So this is just something to keep in mind. I will tell you that in all of my years before this came through in the pandemic, I never saw a single anyone get in trouble over it. But my job is to tell you what the law is, and so technically, this right now you don't want to have telemedicine with an HSA benefit. There's also some question, and this is really a gray area, of whether standalone telemedicine counts as being part of the overall health plan. So there could be a difference between telemedicine that's embedded in your health plan and telemedicine that's a standalone benefit. That is definitely a gray area. Okay, next I want to talk about what the focus is of the new administration, because they've done some things, but mainly you need to understand kind of the direction and the way they're looking at things. For example, Medicaid, and you might say, Medicaid, that's not about what I'm doing. Well, it could be, because they are definitely looking at first attacking fraud and abuse and adding work requirements. And then they're also looking, which they haven't done this part yet, but they're also looking at the Medicaid expansions that passed during the ACA, and California had already expanded, but in some other states, if you have multi-location business, they're looking at possibly rolling that back, or saying we won't roll it back, but we're not going to continue to match that at the federal level on an enhanced level. So what that means for you as an employer, if any of this stuff occurs, which at least the first part would, is that you might have some people who previously declined coverage that now would be electing your coverage because they were no longer Medicaid eligible. And so if they do come off of Medicaid eligibility, that is a special enrollment into your health plan opportunity for them. Also, they're looking at more options under Medicare Advantage. Probably doesn't affect most of you, but that is a really big priority of the administration. They're talking about expanding access to association health plans. They were not successful with this in the first Trump administration. In fact, it was shut down in court. So they would probably need Congress's assistance in order to actually pull this off, in order to get around the negative court ruling. And then short-term limited duration coverage. I feel like this, the limits of what you're allowed to have, which kind of it's more used in other states, but basically it's bounced back and forth between how the Obama administration defined it. It changed during the first Trump administration, changed back during the Biden administration. So I'm sure that they'll try to change this on a regulatory basis, and they probably will be successful. And then they're talking with their new appointments to HHS and CMS about doing more in the area of chronic disease management, primary care access. And then another thing that could affect your plans is that they're talking about another thing that was enhanced during the COVID period, and that was they changed the formula for which people who were buyers in the individual market, they changed the formula as to how much of a tax credit someone could qualify for. So and they're talking about that automatically expires at the end of this year. And they are definitely, I'm going to say 99% not going to renew it, which means that there still will be tax credits in the individual market, but they will not be as generous as they are today. And that could also kick some people back into eligibility for your plan. So just know that don't be surprised if you get some of these people who are no longer eligible for Medicaid or no longer eligible for enhanced premium tax credits now looking to enroll in your plan. I want to talk a little bit about Robert F. Kennedy Jr. And gosh, there seems like there's always some controversial something going on around him. And definitely he's a different sort than we normally have seen as an appointee in an administration. He's got some controversial ideas, that we've heard a lot about vaccines, but I think he's not really necessarily anti-vaccine, as he questions it on some vaccines, and he does question some of the components that are in certain vaccines. I think his big job that he's been assigned by President Trump is to really try to address childhood chronic diseases before they become adult chronic diseases like obesity, like diabetes. And he does have a different way of looking at things. So it could bring some changes into this new administration that we haven't seen before, some wellness-oriented things. We'll have to see what he focuses on. And we have to keep in mind that some of the things that he would do at HHS would most likely be aimed at fully insured plans. So if you don't have a fully insured plan, you're more likely to see action coming that would affect you from the Department of Labor. But there will still be a lot of things that they're responsible for. For example, HHS has a division called SOCIO. It actually is under the CMS umbrella, and they are responsible for everything ACA, except for penalties, which I'll get to later on. And then also, you might have seen that Dr. Oz was recently confirmed to oversee CMS. He also has some really unusual ideas, particularly about alternative health treatments. And he's a very popular. It's focused on, the people have seen him on television, and they've seen him doing guest spots on various news shows. And so people kind of like to hear Dr. Oz, but he does have some ideas that are not exactly mainstream. So we'll have to see how that affects the decisions that he makes that are coming out of CMS, particularly those that relate to ACA. So think of things like changes that could be as a result of, what's the preventive health care benefit, and redefining that. What is chronic disease, and what are other things. They might define things a little bit differently rather than throwing everything out. I don't think anyone's trying to do that, but they might define it differently in such a way that would make produce some changes in the plans that you have. So opportunity, maybe some challenges. We'll have to see what they do. So I really want to focus on the new administration for a few minutes and talk about, what is it that any new president can do? So any new president coming in can change things that were done by their predecessor. So I'm not talking about things that Congress passed necessarily. I'm talking about things that were executive orders or regulations that came out of the agencies. And they can change some of these, but not all of them. For example, there's a law called the Congressional Review Act that allows Congress itself to overturn regulations that were issued in the last few months of a previous administration. And by last few months, I don't mean literally, October, November, December. What I mean is the last few months that Congress was actually in session. So the last time Congress was actually in session, last year, we have to go back to August and start counting from there. So any regulation that was issued, this date is important, by the way, and I'll tell you why later. But this August date is important. And so anything that came out, a proposed rule or even a final rule that was issued during that time, can be questioned. They can put a freeze on it, which they've already done on some. They can also, the president can also, there's always something being challenged in court. The president could even direct agencies to completely change their stance on ongoing court cases. So if the prior administration took one position on a pending court case, the new administration could completely order them to go a completely different direction if they wanted to, or to withdraw from any action that they had brought or were a party to. And they can, one of the things they can do when they freeze these regulations or revoke them, they usually freeze them and they go back and look at if they want to just redo them. So sometimes they want to just go in and change some of the provisions from a rule that was issued and not just completely throw it out altogether. And then sometimes they just throw it out altogether. But it does give any incoming president, and by the way, any president that's coming in for the first time in particular, they have this opportunity. All of them do, and all of them take advantage of what their ability is to reshape their administration right from the get-go based on what was done at the end of the prior administration. So President Trump did issue a government-wide regulatory freeze as soon as he took office. So that really kind of stopped in its track anything that had been proposed or finalized during those last few months of the Biden administration. It's a 60-day freeze, and they're going through a lot of things, looking to whether or not they want to, again, do away with them altogether. They did do some things relative to the Health Insurance Portability and Accountability Act, which is the HIPAA security rule. We're looking at some additional things relative to that had to do with, some of them had to do with IVF and some other issues kind of in that category. There was a rule regarding nurse staffing mandates. And then there were a number of things that had to do with the Medicare Advantage and Medicare Part D programs. And one of the things I want to say is that if you tend not to look at what's going on with Medicare, you really should pay attention to it, because often things that happen in the Medicare program happen and then trickle down to the private sector. Although sometimes things happen in the private sector and trickle up to Medicare, but there is definitely a relationship there. So some of the things that they have, we're looking at that they totally revoked altogether, there was an executive order that was issued during the latter part of the Biden administration that had to do with access to cell and gene therapy. And they were particularly looking at making sure there was adequate access for Medicaid programs. But again, what they were doing probably could have had a further reach than that, and could also have affected the cost of your plans depending on what they had decided to do with it. That one is, I think they are not really looking at that very closely. The other one was get a $2 drug list model for Medicare, and I do think they've completely scrapped that one at this point. I would have thought that would be the easiest one to implement, but no. And then they were also looking at, and they still are looking at, accelerating the availability of Medicare funding on drugs that had gone through the FDA under an accelerated approval process. So it doesn't, again, when they rescind these, it doesn't automatically reverse them. It just says that we're going to freeze it. We may bring it up, and until you hear from us otherwise, which we have on that $2 drug list, they're going to kind of realign with what they think are the most important things. And you probably also heard about the executive order on pricing transparency. So what they're doing with this is they are really, I'm trying to say this correctly, they're pretty angry about the number of hospitals that basically are not, in some health plans, but it's mainly hospitals that are not complying with the transparency requirements or only partly complying with that. And part of it, one of the things has to do with the posting of online prices for things like MRIs and C-sections and some of the things that were on their top priority list. So I do think that this is something that they will focus on. And the reason why I think that is that there are people in the administration that don't work for agencies, that work for the White House, that their whole job is everything to do with health policy. So they work for the Domestic Policy Council or the Council of Economic Advisors, one of those two or both. And they were focused on this during the last Trump administration. And the same people who were working on it before have been reappointed to those positions, which is kind of unusual for them to bring back someone like that who had already gone on to the private sector. But they did. And so they're focusing again on that top priority of pricing transparency. There was also some changes to the enrollment process for coverage that's purchased on the exchange. This mainly affects the federal exchange and not Covered California, because Covered California has its own rules. But some of the things that do trickle through is extended open enrollment periods, because there's a thought that increases the overall cost of coverage, and because federal premium tax credits reimburse the cost of coverage on anything that would encourage what they call adverse selection, or people waiting until they're sick to get covered, is something that they're opposed to. So we could see some changes there. And again, some of that could affect people flowing back into your plans, which is why I mention it here. Also, funding for the ACA Navigator program was reduced. There's nothing that states can do about that unless they fund it out of state appropriations. They were mainly focused on Medicaid, but some of them did work with low-income people who were qualified for premium tax credits as well. And those are the primary things. I mentioned before already about the changes to the subsidies, so I won't dwell on that. And I do want to talk about Congress, because an administration can't do things on their own, although they will try for sure. They all try their hardest to work around Congress, and they get away with some of it. Every administration does it, not just one or the other. Doesn't matter which party they are. They all try to do things more quickly, but they do have to take Congress into consideration. So let's take a look at Congress. So one of the things that we see that was similar to the last administration is that we have narrow majorities in both the House and the Senate. The fact is that the Republicans control both the House and the Senate, but particularly in the Senate, when they have a really narrow majority, they aren't able to do things as easily as you would think. And that's because in the Senate, most bills would pass only with a supermajority. So there are procedures designed to slow things down, like you hear about the filibuster or parliamentary holds, and those require 60 votes to pass. Well, if Republicans only hold 53, you would think they could get 7 Democrats to vote with them. But on most issues, they can't. And in fact, they may not get every Republican to vote the way they want. So it's very hard to hit that supermajority unless it's something that is just really completely an emergency measure, like we saw in 9/11 and things like that. And then they voted together. And once in a while, they'll do it on other things. But it's really, you almost never see this happen, that they reach that 60-person majority. I'll talk in a moment about what they can do without having to get those 60 votes, which is very important. But now let's flip to the House. The House is also narrow, 220 to 215. It only requires, in the House, things pass with a simple majority, which only requires 218 votes. But that means that pretty much all those Republicans need to vote as a bloc. And I will tell you, the diversity among Republicans is dramatic, and they don't all vote together. They argue a lot. So sometimes it's very hard for them to get enough votes to pass, but they are much more likely to get something to pass out of the House than in the Senate. But when they do pass something out of the House, it goes to the Senate, where it goes to die sometimes because it can't get past the supermajority rules. The other thing I want to tell you is that when we have a new president going in, we have the presidential election, and then 2 years later, we have the first, what's called the midterm election. And no one in the administration is up for re-election. It's just Congress. It's every seat in the House and 1/3 of the seats in the Senate. Well, historically, in our country, with very few exceptions, during that midterm election, whichever party is in the White House, the other party picks up seat in the House. So with a majority that is so close like this, 220 to 215, it's very, very likely that Democrats could take over the majority at that midterm election. So why that's important for you to think about right now is that I guarantee you that the Speaker of the House knows that fact and that statistic very well. And they will work like crazy to get every single thing that they can get done that's possible for them to get done in the first 2 years, because they know they may not have the ability to control the agenda the second time or during the second 2 years. So narrow majorities in both the Senate and the House make passing legislation really tough. How tough it is? Look at this example. This is from the last Congress. So there's lots of legislation that gets introduced. So look over here on the House side. These are only bills that have to do with healthcare and pharmaceuticals. So there's many, many more pieces besides these that were introduced. But let's just focus in on kind of our area. So there were over 1,000 bills introduced in the House, and when they're introduced, they are assigned to a committee of relevance based on what it's about. And of those 1,007, only 14 were approved by a House subcommittee. There were 16 that actually passed the House, and the reason for that is two of them were fast-tracked because they had already gone through the hearing process at the end of the prior Congress. So there was already a fairly recent committee hearing that had been held, but 16 passed. Then they go over to the Senate, and on its own, this introduced in the Senate, including the 16 passed in the House, there were 553 introduced. When they go over, even if they're coming from the House, they still have to go into consideration by the Senate Committee of Jurisdiction. And of those, 6 were approved by a Senate committee, and 6 passed the Senate. 3 of them actually became public law for a variety of reasons. And I want to remind you that the 118th Congress was a 2-year period. So this is how hard it is to get things passed when majorities are narrow. And so the result of that is that you have an empowered administration that says, look, if Congress is not going to get anything done, we are. But there are some advantages of the Senate, in particular being in control by Republicans. It's a Republican advantage. I'm not saying it's good or bad for us. I'm saying it's an advantage for them. So they do have, even though they have the filibuster and parliamentary holds, there is a measure called a budget resolution. And each year there is one budget resolution. It is controlled by the parties in power on the Senate side. So it comes out of the Senate, and it allows, it has to be related to something that either spends or saves a lot of money. And that has to be the bigger priority as opposed to just changing policy. For example, if they wanted to say, we're not going to have filibusters anymore, they couldn't do that with a budget reconciliation bill because it's not about money. But they could do a lot of other things. And in fact, the ACA passed under a budget reconciliation bill. So it allows the party in control the agenda of what goes into that budget resolution. and it allows it to be passed with only a simple majority. It's the only legislation that can go through with a simple majority. And there are a couple of other exceptions, but mainly it's just the budget resolution. It also allows them some control on which federal judges are confirmed. It controls presidential appointments. The Senate, the party in power, controls whether they are confirmed or not. And so this does give them a lot of ability to do things on the Senate side. Senate Republicans are significantly less likely to lose control of the Senate at the midterm election than House Republicans are. So this may be something that lasts all 4 years. So some of the focus of the new administration, and as well as Congress, has been on extending all of the 2017 tax cuts that were passed in the first Trump administration, and when they're set to expire at the end of 2025. They will use the budget reconciliation process to expand on what they've already been able to do with this. And sometimes budget reconciliation bills can loop forward from year to year. So if one is not used at the end of a year, so for example, if they didn't use everything they were able to use at the end of 2025, it could transfer forward to 2026. So sometimes we've seen 2 budget reconciliations in 1 year, but that's kind of unusual. One of the things that they are going to be looking at that I am going to talk about more in just a minute is the tax exclusion on employer paid benefits. So this is not, they aren't really looking at the employer's tax deduction for providing benefits. What they're looking on is the exclusion in that your employees are not taxed on the amounts that you pay toward their benefits. It's not considered compensation, which also means that, you also don't have a FICA match on it. It's just not considered compensation. So some of the good things that have some bipartisan support that could happen still during this year would be things that what's called site neutral care. And so think of, and I know you can think of this probably a lot in California in particular, we've seen so many hospitals that purchase physician systems, and that sometimes that is a good thing, and sometimes it increases costs. But what we has a lot of support among members of Congress is basing the cost of procedures, particularly in the Medicare program and in Medicaid, on the site of care, not basing it on site of care. So it's the same if the procedure is done in a physician's office, and it's also done in a physician's office that is hospital owned, that the price is the same and doesn't have a hospital outpatient fee added to it. So anytime the cost of care goes down, that reflects in the premiums that you pay for your coverage. So those things, depending on how they were structured and that they didn't hurt rural hospitals and things like that, are things that have some bipartisan support. In a Republican-controlled administration, you would expect them to go very slow on that. So they might just start with Medicaid, for example, or they might start slow. But if they do expand it into Medicare at all, it would affect private coverage as well, because many private coverage payment rates are based on a percentage of Medicare. And then they are, again, still talking about this extension for telemedicine for private plans that I mentioned earlier. They're also looking at other things in terms of the definition of a qualified high deductible plan, because the original definition is pretty old. And right now, almost everybody has some level of a high deductible. So they're looking to allow more people to be able to have HSAs so that they are able to pay for their out-of-pocket health care on a tax-preferred basis. So they're looking at allowing more primary care in general, not subject to the deductible, and changing that definition to allow that. And also things like direct primary care so that it wouldn't disallow it, or on-site medical clinics and things like that. And then the other thing that has a lot of bipartisan support is PBM transparency, to make sure that there's not unnecessary cost in the pharmacy benefit managers, that doesn't add unnecessary cost to the system. There are a lot of different opinions on how that would be implemented, though. Many different opinions on that. So we'll see if that actually goes through. But I feel like we'll get a little bit of it this year, maybe not as much as we had thought might occur. And I mentioned direct primary care. And this is actually, I'm going to go through this quickly. This is actually legislation that would make direct primary care allowable to be used with HSA plans. This is pretty popular. It has not been reintroduced this Congress, but that's because the Congress is pretty new and they've been focusing on other things, but it will be reintroduced. And it is something that could help people, even with high deductible plans, be able to have an HSA and still be able to get some primary care for themselves and their families without having to meet their entire deductible first. The idea behind this, and it should have some support from HHS because of the view on primary care for children in particular. The idea behind this is that if people get the primary care and wellness care that they need ahead of time, that it would save costs in the system. I mentioned transparency before. There was actually legislation that passed towards the end of the last Congress, and it didn't get all the way through the process. We thought it would be added on at the end of the year in an end of the year bill, and it was not. But I'm sure that they will pick this back up. It had bipartisan support. This legislation passed out of committee on a unanimous basis of Republicans and Democrats last Congress. So this should be able to go through. It's just a matter of whether it gets to the priority level. So it includes, language on pricing transparency, some kind of PBM light reforms. The site neutral things that I mentioned were in there for Medicaid, actually, and some additional things on community health centers. I do want to spend a few minutes talking about the tax exclusion. And I want to start off saying that this is something that has been brought up the entire time that I've been working with Congress, every single year for 25 years. So why does it matter so much right now? Well, we have this serious look at reducing the overall budget. The employer tax exclusion, so this amount that employers pay for benefits, has gone up and up and up because the cost of coverage has gone up, because the cost of care has gone up. And so it is now the largest tax benefit that there is. So it represents currently about $300 billion in what they consider lost federal revenue every year. And as they're looking at this cost cutting, we really have to take these suggestions that we should either take away or cap this tax exclusion more seriously, perhaps, than we have in the past. In years past, we've been able to push it back, but we're now looking at a little bit different of a scenario. So we really have to consider whether or not this could go through and what the impacts could be. So it would definitely create a tax burden on your employees. And that's a problem. It's not just a problem because it's a tax burden on your employees. It's also a problem if those employees decided that they didn't want to take the tax burden and they'll just opt out of coverage. So the ones that would opt out are the young and healthy, for sure, the ones that think they're invincible, and not the ones who are the biggest utilizers on your plans, which would push up the cost overall of coverage. So it could increase your overall cost of coverage, whether it's removed or capped, and create some additional administrative complexity if they capped it, figuring out what the caps mean, how you calculate what the cap is, particularly if you're a multi-location group. The other thing is that employers' FICA match would go up. I mentioned that earlier, and how much it would go up really depends on whether they eliminate the exclusion, or the more likely result is they would cap it. The problem with caps is that it's really hard to make them fair, particularly if you're in a group where benefits are age rated. So how do you say what a fair amount is if everyone has a different rate based on their age, number one? How do you account for geographic differences? And in groups where you've got a different, an older age population, or you've got a kind of a sicker population, how do you make that equitable? How do you make sure that it doesn't disproportionately affect people that are older or less healthy in your workforce or in higher cost areas? If you've got multi-location groups and, some of them live in New York City and some of them are in California, your New York City premiums are probably higher than California is. How do you make sure that it's fair to everyone? So these are a lot of the concerns that employers could be faced with. And then also there would be new compliance and reporting requirements. So it would increase administrative burdens. And I will tell you that Warner Pacific and the various coalitions that we are involved with, as well as our professional associations, are working on this along with many, many business groups, and it's a top priority. But I want to let you know that it's going on because it's not something we hear about too much on the news. It doesn't show up in your mainstream news. This is a huge priority, though, for finding some additional revenues. So it's a reality that hasn't been as big of a reality as it is today in the past. I just wanted to put this chart in here for your health plan limits. You'll get a copy of these slides. So if that's useful for you, if you already know all of this, never mind. It's in here if you need it. And then the last thing I want to talk about, super important, and then we'll go to questions. One of the things that came out during that latter part of the Biden administration was a very onerous rule regarding mental health parity. And it took the requirements that were initially created for a comparative health analysis that in the past were based on the plans that you offered and expanded them to include how the plans were actually used, which number one is information that's very hard to get. And second, there are many other things that are added to this that are extremely expensive. So this is one of the pieces of a regulation that has been frozen, but it has not gone away yet. So this is something we're going to be watching really closely, and we'll certainly keep all of you informed as to what's going on with this. But it's not that anyone would oppose mental health parity. It's just that sometimes if you drill down, sometimes the problem with mental health parity is getting enough providers to actually participate in a network. And some of them just don't want to participate because there's such a shortage of mental health providers that they don't have to. And so it's sometimes difficult to meet network adequacy requirements. And especially when they drill down into these sub requirements of super specialists in certain areas, it's really difficult. So this is something that just to keep in mind, because there is a requirement already that employers have a comparative analysis. But what they are looking to expand it to would be much worse than what the requirement is today. So this is something that we will see more on this, and we'll keep you informed. But this and the tax exclusion are the things that I have the most concern with, of the things that could possibly pop through, although of course there are others. And again, the other thing I'll bring up is you can expect some changes on the definition of preventive care. That is something that can be done on a regulatory basis, and they are likely to do that. I think that they are already looking at that. So just some heads up on things that they're looking at. So I don't know if we have questions, but if we do, I'm happy to answer any that we have.
We don't have any right now. So if anyone has any questions, you can put it in that Q&A box, and Janet will answer your questions.
It doesn't have to be about something I talked about, by the way. If you have a different question, you can ask that too. because there's so much to talk about. I could spend all day talking to you about all the different things that are out there to be thinking about and making sure that you're doing and that sort of thing. But I know you're getting great advice from C3.
Janet, one of the biggest topics right now is alternative funding, right? And captives have made alternative funding much more doable thing to look at and review for smaller size accounts now. So more companies looking to get into the self-funded world. I know it's been a big topic of conversation. Or is there anything on the horizon or anything that companies should be aware of in a move from what they're used to with fully insured into self-funding?
Well, there are, when you move into self-funding, there are some additional things that you have to do from a compliance perspective. There are some things, they're not really horrendous when you move into that area, but let's talk about that for just a second. We do have some pretty specific rules in California in particular and in New York relative to self-funding, and they are state rules. And the reason why they can be, even though self-funding is you think of that as being federally regulated, there are some state regulations that regulate the stop loss that you absolutely must have in a self-funded account. So I'm mentioning this first, and then I want to talk about the captives and so forth, and your requirements and responsibilities. There's no big trend from the administration to change anything about self-funding. They like it. But they also like to flip things to the states and say, you do what's best for your own state. And that may not be the best thing when your state is going to take an action that really restricts your ability to have that as an option. If we address captives themselves, captives are a good option sometimes, not for everyone. Captives are a type of self-funded plan where you're kind of buying in as a member of the plan. It's a real long-term decision, but you want to make sure that you go into that understanding what your responsibilities could possibly be. And both if the captive is undercapitalized, you could require, you may be required to pony up some additional funds. It's usually not a huge amount, but it could be some. It's called a capital call. And there's also a requirement for some going in money where you're either writing a check for the full annual amount of collateral dues is what they call them. And sometimes it's not a bad thing, but you have to be really careful that you understand the implications of going into it, as well as other self-funded arrangements. And they're not necessarily a bad thing. I don't want to imply that at all, but you have to understand that there are additional responsibilities, some additional fiduciary responsibilities for you as the employer. You are, if your plan gets sued, they're not going to sue your insurance company. They're going to sue you. And that's one of the biggest liabilities that you take on. We don't see that a lot, but there's a lot of discussion about, you might have seen in the news where some employers were being questioned. Johnson & Johnson was one of them, about the way they structured their pharmacy benefit program and if that was the best way to fund their pharmacy benefit program. And did they do their due diligence in choosing the lowest cost access for that and so forth. So you might find some also in any self-funded plan. I will say that don't assume that just because you had such and such coverage before and it was through, I'll just pick one. Let's say it was through United and you go into a captive, and let's just pretend for a moment that United had their own captive or even a United level funded plan. When you go into those plans, don't assume that the benefits are the same because it's United to United. Remember that with self-funding, you don't have to comply with state mandates. So there may be some things that were covered under your fully insured plan that would not necessarily be covered unless you specifically write them in. So the devil's in the details. You have to be very careful. And it's a great option when it is a great option. And it's when it isn't, then No, not so
Thank
much.
you. Thank you. It looks like we might have a couple questions.
We do. We have a question from Ben Wood. Question is, do you see compliance continuing to be an integral part of employer strategy?
Yes, it's when you hear the administration talk about reducing regulations, it doesn't mean that they're going to go away. And some of the things where they're reducing regulation may not be the areas that you have to comply in. So we might be able to push some of them down. For example, the mental health parity stuff. I think we have a good opportunity to do that. But I don't see compliance going away. You will have to do it there. And part of it has to do with, I will just use one thing quickly as an example. So when we originally started working on that reporting legislation, we asked them to get rid of it altogether and put in a new voluntary system. And the IRS stepped in and said, no way, because if we're going to have premium tax credits, we have to know who has a valid employer offer. And that also came from the House Ways and Means Committee when Republicans were in charge. So it's not a partisan issue. It's a matter of what they feel is making sure that there's no double dipping going on and that type of thing. I don't think the reporting will get, or any of your compliance duties are going to get too much better. I wish I could tell you something different, but no.
The next question is there anything on the horizon that we expect to affect co-employment/PEO health plans?
That is not a target. And it's not a target. Some of those plans are fully insured and some of them are self-funded, but no, I don't see anything in particular aimed at the co-employment issue. That's not on their radar screen. I've heard no one talking about that anywhere. Unless it came up at the state level. Remember, they just love to say, leave it to the states. So that's very common for them. Remember, they've used that strategy on a lot of different really touchy issues. So don't think that is not a pattern they wouldn't adhere to. They will do that. So we have to watch that one.
Well, if there aren't any other questions, we can probably wrap it up. I just want to, on behalf of C3, I want to thank you, Janet and Warner Pacific, for being here today. We really appreciated your insights and information on what's going on out there. I know we'll all keep close attention and close watch. I'm sure it'll be a rapid year. And we appreciate your time. And thank you, everyone, for joining us. On behalf of C3, we wish you all a great week.